Today, we're going to run through the growth potential of each stock that I own, as well as give you guys some buy prices on those stocks. And finally, I'll leave you with my potential 2030 portfolio size. Coming up, I am beating the S&P 500. ASML is an incredibly tricky one to value. Now bear in mind that the last time they gave us 5-year guidance, they doubled it. I have a massive position in HIMS now of coming up to £10,000. Meta will not be able to continue growing their user base, but people have been saying this for ages. It just seemingly is continually undervalued. I think I'm being a bit harsh here. My estimated portfolio size by 2030 is, as some of you guys may know, I am beating the S&P 500 over a 2-year period by about 26%, as you can see here. My portfolio is sitting at about £48,708, and if I was to invest in the S&P 500 the whole time, my portfolio would have just sat at £39,692. So, with that being said, I plan to continue beating the S&P 500. And to do that, I need to evaluate my stocks and the stocks that I own and see how much of a growth potential and how much returns I should expect to see from my stocks. So I've done that for you today. And what I've done is I've estimated the price of each stock by 2030. So without further ado, let me get into our first stock. So I'm going to be using a discounted free cash flow exit multiple method. I use this through a website called Qualtrim. Essentially, you just put in the current free cash flow per share, the free cash flow growth rate. So for Texas Roadhouse, I think it would grow at 15.23% in the coming 5 years. And then you put the free cash flow yield that you think Texas Roadhouse will be trading at in 2030. So for Texas Roadhouse, I have looked at the current multiple, the historic multiple, and what I'm doing is I'm always choosing the higher multiple. So when it comes to free cash flow yields, I'm choosing the highest free cash flow yield for each stock. And this is a lenient measure. This means that I'm not expecting this stock to trade at an increased premium. So for this example, I've chosen the current multiple of 3.72 because it is higher than 3.5. If I was to say that the stock was to drop from 3.72% free cash flow yield to 3.5% free cash flow yield, that would mean that the price of Texas Roadhouse would have increased if that happens. So I'm saying that it stays the exact same in free cash flow yield basis. Then to calculate Texas Roadhouse's growth rate, I have used the 10-year stock-based compensation adjusted free cash flow per share. Now that is a mouthful, but essentially it just means the free cash flow per share when you remove dilution, such as the company giving stock to their workers. Now, they grow their free cash flow per share at 21.75% over the past 10 years. That is incredibly fast. So what I've done is I've given it a growth rate slowdown. So I've taken 30% off of the current growth rate because Texas Roadhouse functions, it's a restaurant, first of all, and restaurants are highly competitive. And because of this, restaurants become quite unpredictable. Also, the restaurant industry has low margins in comparison to the tech industry. So I've given it a huge slowdown rate of 30%, which I don't know. I think I'm being a bit harsh here. And this gives us a 15.23% adjusted future free cash flow growth rate. So you can probably see here that I've highlighted in yellow the current multiple that I'm using and the adjusted growth rate. And what I've done is anything that's highlighted in yellow, I'm using as the numbers to put into the analysis tool. So if we put in a free cash flow per share growth rate of 15.23%, free cash flow yield of 3.7%, we can see that the return from today's price should be 15.26%. So right now at Texas Roadhouse at $191.41 is a buy, and the entry price for a 15% return is $193.55. So buy anywhere under that price and you'll probably get a 15% return, if not higher, if you consider the fact that I have taken a growth rate slowdown of 30% here. Not to mention also that it trades at a historic multiple of 3.5%, not 3.72%. So there should be a little bit of growth in that area as well. So currently I own about £3,859 of Texas Roadhouse, and my return is £1,674. That is a 76% increase because my average price is $101. So I was buying this about 2 years ago, I think, and it was one of the first stocks I individually bought, and it's given me a great return. I'm about $90 below what it's currently at, and 1,800 in returns, but I lost about 6% on foreign exchange, which sucks, but that's how we do. Right, on to the next one. Amazon. Now, I'm surprised by Amazon because it just seemingly is continually undervalued. I don't really understand. I think that it's the high capex that is causing it. So for Amazon, I've used operating cash flow instead of free cash flow. Now, that is because they have high ongoing capital expenditures. So it's really hard to tell how efficient Amazon could be if they were to stop with the capex. So for Amazon, using operating cash flow is a much better metric than free cash flow. Now, it's currently trading at a price to operating cash flow of 20.5. So that is the multiple I'm using over the historic multiple of 25. So it's currently trading a lot lower than it should do historically. Now, its previous 5 years of operating cash flow growth was 23%, 45. Now, I'm giving them a growth rate slowdown of 20%, and this is because they have discrete capital allocation. And what I mean by that is a lot of their capex spend, they don't really disclose what they're doing with it, so we don't know or if we're going to get decent returns from this capex. So with the 20% growth rate slowdown, that brings the operating cash flow growth rate to 18.76%. So ignore the fact that this says free cash flow and free cash flow per share multiple and free cash flow per share growth rate. We are using operating cash flow. This is just a basic calculator with a graph plotting machine. The free cash flow doesn't affect it. So we can see that the return from today's price should be 18.75%. And I think that Amazon right now is a buy. I want to continue buying it. Next time I get a paycheck, I probably will buy some. And the entry price for a 15% return is $250. So I'm going to be buying Amazon anywhere under $250. I currently own about £7,295 of Amazon, and I'm up 1,171. So up 23% from my initial position, which was 170. It was my average price. Moving on, we have Meta. Now, Meta currently trades at a multiple of 3.51%, and its historic multiple is 3.8%. This is free cash flow yield, by the way. I've chosen the historic multiple of 3.8% and given it that discount. Now, with Meta, I have used... So what happened with Meta is they became... Let me actually just quickly show you. If we have a look at Meta's capex, it really peaked and then it dipped back down. And this was when Mark Zuckerberg was talking about doing his efficiency. It was in his efficiency era, and he brought capital expenditures down. And that is what I call maximum efficiency. When the capex was at its bottom, free cash flow was also rising really quickly. So what I've done is on my calculations and assumptions tab up here, I use the previous max efficiency, which is from Q1 of 2024, where they had a capex of 26.82 billion and a free cash flow of 49.54 billion. Taken the operating cash flow from there, found the free cash flow efficiency, which is about 65%. So I reckon that the max efficiency of Meta, based on its previous max efficiency, is 65%. I've then estimated future operating cash flow because I know the 5-year operating cash flow growth is about 20.39%. So what I've done is I've estimated, so what I've done using the free cash flow efficiency is I've tried to find the future free cash flow in 2030, but using operating cash flow. So first I need to calculate the future operating cash flow, and to do that I have looked at the historical 5-year operating cash flow growth of about 20.39%. I've then adjusted for a 20% slowdown in user growth. The law of large numbers probably means that Meta will not be able to continue growing their user base, but people have been saying this for ages, and it's just kept going. But nevertheless, I'm giving them a minus 20% for this slowdown in user growth. So this gives me an adjusted future operating cash flow rate of 16.31%. And using that 16.31%, I calculate the future operating cash flow by 2030 to be 204.57 billion. Now, using that, I have calculated the future free cash flow. And I've done this by timesing operating cash flow by 0.65%, which is our free cash flow efficiency. And it's given us 132,970 million. So using that future free cash flow from 2030, I have found the growth rate to be about 20.5%. So if I input that into the calculator, it will give me a return from today's price 16.14%. So I believe Meta is a buy right now. Anything below $688 I believe is a buy and will give you 15% returns. I'm going to be buying Meta and Amazon, I think, throughout this quarter, so stick around to see how that turns out. I currently own £1,207 of Meta, and I am barely up. Well, I say I'm barely up. I'm 14% up, but I don't have much in there, so it's only £151 that I've made on my current position in Meta. Moving on, we have ASML. Now, ASML is an incredibly tricky one to value, so let me help you with that. So ASML is a cyclical stock, so this means that it goes through cycles of profitability. Let me show you quickly on here what I mean. You can have a look at ASML. You'll notice a trend in the free cash flow. So you'll see how it peaks really high and then falls back down and grows and then falls back down and then grows and then falls back down. So it's a cyclical stock because essentially the buyers of their products go through phases of not needing to buy anything from them, and then all of a sudden they need to buy from you again because they need to get the latest wave of EUV chip making machines. So what I've done for you guys is I have shown 3 different parts of the cycle. So I've shown ASML when it's in its low efficiency mode, intermediate efficiency mode, and its max efficiency mode. Max efficiency is when they're getting peak free cash flow. Low efficiency is when they're getting the lowest point of free cash flow. And what I've done is I have color coded these with the inputs that I have given them. Now I have given all of these adjusted future free cash flow growth rates a 10% slowdown. I've only given them 10% because I believe their moat is truly untouchable, and most competition is about 5 years behind being able to produce as many chip manufacturing machines as ASML do. So for ASML, I have calculated on the calculation and assumptions section the previous max efficiency. So I've used trailing 12 months Q1 2022, and I've taken the revenue from that period and the free cash flow from that period to find the free cash flow margin for that period of max efficiency. Then I've used the future revenue, and I've used the middle of the guidance, so 50 billion they've said by 2030 is what they estimate. Then I've used the revenue to calculate the future free cash flow for that year using the max efficiency calculation I used here. So 57.3% of 50 billion is 28.65 billion in free cash flow, and then I found the free cash flow growth rate using that, so it is 22%, 37. So that hence the 22.37% future free cash flow I've highlighted here in green. I have then taken the 10% off of it, and it's left me with 20.13%. So if we consider that ASML is in a period of max efficiency in 2030, then an entry price for 15% is anything below $770 per share. Currently, ASML as of today, 761.87. So it will return about 15% from here. If we were to say that ASML would be sat in its intermediate efficiency stage during the year of 2030, then this is actually the best time for ASML, with 822.79 being the entry price for a 15% return. If we look at the low efficiency tab, entry price for a 15% return is about 580.29. So we're hoping that by 2030 that ASML is not sat in its low efficiency mode, which it could well be. We just don't know which point of the cycle it will be by 2030. So in terms of ASML, I own about 3,600 of this stock, and I've only just broken even. And now most of this is because of the FX impact. I'm actually up. I've actually gained about 7%, but I've lost about 6% to the foreign exchange impact. Moving swiftly on, we have Booking Holdings. It has a current multiple of 5.14% and a historic multiple of 5.5%. So I've chosen the historic multiple. Its 10-year stock-based compensation adjusted free cash flow per share growth has been about 16.87%. So this is really good. But what I've done is I've taken 25% off of that. I've said that it's going to grow at a 25% slower rate and at 12.65% due to the travel sector being hit hard during recessions. So just in case that happens, that's what I've taken off. This is like my discount. So if we put that in, for return from today's price is 10.09%. And if you want a 15% return, you'll need an entry price of about $4,234. So for me, luckily I got in before then at $3,971, and I'm currently up about 27.5%, 31.5% if you remove the foreign exchange impact. And yeah, this has been a great holding for me so far. I'm not going to be adding to it though, as the return from today's price is only 10%. I'm always looking for 15%. Moving on, we have Uber, and they are trading at a current multiple of 4.01 free cash flow yield. Historically, they trade at 3.16. So usually they trade quite a lot higher than this in terms of, if they were to trade at 3.16 right now, the price would be much higher. However, I am going to say that in the future they'll trade at a 4.01% free cash flow yield. So when it comes to Uber, because they are quite recently profitable, we are going to use their revenue and the free cash flow margin over here to calculate the future free cash flow using its current efficiency, a free cash flow margin of 14.3%. So management expects revenue to continue growing at around 16%. So the future revenue that I've calculated is 25.12 billion by 2030. And then I've used the future free cash flow efficiency, which I calculated here to be 14.3%, which gives me $3.592 billion in free cash flow by 2030, which gives us a growth rate of 16%. So with the free cash flow growth rate of 16%, I've taken a 20% growth rate slowdown off that just because of the autonomous taxi fears. Now, I personally think autonomous taxis are going to benefit Uber, but I've taken it off regardless because these are quite conservative measures I've taken on all of these stocks. I personally believe that these stocks might grow a little faster than what I'm actually putting in here. But I'm truly trying to find what stocks are undervalued here, and taking these growth rate slowdowns into account really shows me what's really intrinsically undervalued. So putting this in, a 12.8% free cash flow per share growth rate and a free cash flow yield of 4.01, we get a 10.47% return from today's price. If you want a 15% return, you need an entry price of 74.72. Now, luckily, I have that. I have an entry price of 63 $63. And my current return is 1,641 on this stock, and my overall holding is £6,094. Moving on to Netflix. Now for Netflix, we are using the rule that we used on Uber, where we're going to use revenue growth to estimate the future free cash flow. So exact same method that we did before. And using this method, we come to a future free cash flow growth rate of 14.5%. We're going to use the historic multiple that's traded at of 1.95%. And for growth rate slowdown, I am not going to give it any kind of growth rate slowdown. And this is because it's the clear winner of the stream war, and I can only see its moat and its earnings begin to increase over the next 5 years as it becomes a larger and more global company. So adjusted, we've got 14.5% because we've had that 0% slowdown. And using these metrics, we get a return from today's price of 9%. So Netflix, I think, is currently a little overvalued. An entry price for 15% return would be about $874. So I'm not going to be buying Netflix. I already have a sizable position in Netflix of £3,682, and my gain is humongous of 71%. So I won't be adding to Netflix, and it is a company I would recommend having it in a portfolio, but I'm sure there'll be a time where it trades at a discount for one reason or another. So just hold on tight and wait around for it to get on discount. Next up, we have S&P Global. So S&P Global currently trades at a multiple of 3.56%. Its historic multiple was 3.6%. So that is what I have inputted into the calculator. Its future free cash flow growth is about 17.7%. Its past 20-year free cash flow growth rate was about 17.7%. So I have said that they're going to continue growing at that pace, minus the 10% because they are selling the mobility business. Now, this might be a good thing for their free cash flow, but I'm going to give the minus 10%, saying that maybe actually their mobility business will be a bad sale. And this gives me an adjusted future free cash flow growth rate of 15.9%. So that's what I've inputted. According to the calculator, S&P Global will return about 15.21% from today's price of 516. Now, S&P Global, I think, is a solid buy. It's just such a predictable company. They will give you the free cash flow they estimate at the beginning of every year, and they're pretty much always bang on. They have been for so many years now. Entry price for a 15% return, $521.61. So I wouldn't be buying it over $521. My S&P Global position is £4,456, and my return is only about 18%. My entry was £412, so quite a fair bit below the entry price for a 15% return. Moving on, we have my largest investment at the minute, HIMS. I really took a huge leap on HIMS this month, and it's paying off. Now, HIMS is quite difficult to estimate, especially because it's such a young company. We don't really know how efficient it will be with its free cash flow. We don't know how fast it's going to grow, but the company's given us some revenue guidance of 6.5 billion by 2030. Now, bear in mind that the last time they gave us 5-year guidance, which they have right now, they doubled it. They doubled that guidance. So I think they're significantly sandbagging this revenue guidance of 6.5 billion. So for the multiples, instead of using free cash flow, I'm using price to revenue or price to sales. So the current multiple is 6.27. I believe that it deserves to trade higher. But the historic multiple is 4.8. So we're going to use the historic multiple. Now, the future revenue growth, as we established, it will reach 6.5 billion by 2030, and that is a 29.57% revenue growth. We take the growth rate slowdown. If we have a growth rate slowdown of 35%. So I'm taking 35% off of, this is huge, huge sandbagging from me. And this is because it's a young company, there's potential for regulation, and has an unproven moat. It gives us an adjusted future revenue growth rate of 19.22% over the 5 years. So if it was to do this, I have calculated that it would only return about 8.19% from today's price of 62.24. Now, for me, I'm happy with this. I really think that that I'm sandbagging it here with a 35% growth rate slowdown. I also think that management might be sandbagging as well, considering that they doubled their last revenue guidance. But yeah, for me, the entry price of $45 is actually a good one. I think I would only be buying HIMS again if it reached $45. I have a massive position in HIMS now of coming up to £10,000. I mean, well, up to £9,000 now. With a return of 3,646. Now, bear in mind, I only really invested in HIMS the beginning of April, and it's only been about a month since I started investing in HIMS. And £3,646 to gain in such a small amount of time is incredible for me. And it's really propped up my portfolio recently, and I'm really glad that I bought into HIMS. But yeah, that being said, let's move along. So, MasterCard, such a consistent company, and it's trading at a current multiple of 2.95. Got a current multiple of 2.95% free cash flow yield, historic multiple of 2.6%, and a 5-year stock-based compensation adjusted free cash flow per share of 15.98% annual growth rate on that metric. So with the no growth rate slowdown, due to it being a duopoly with a clear tailwind, and the tailwind is cash is slowly being taken out of the economy, and less people are using cash, more people are using credit cards, debit cards, online payments. So that being said, we get a 15.49% return from today's price. So I think MasterCard is a buy currently. I might actually buy into MasterCard because it's just such a consistent grower. Its fundamentals are almost perfect, and it's a great company to have. I'd be buying anywhere below $591.34. I currently own about £2,919 worth, and my return has been £766, so 35%. Originally 42%, but obviously the foreign exchange impact, which I hope will even out over time, by the way. So moving on, we have Salesforce. Salesforce is a really weird one because their revenue has significantly slowed. So it's currently trading at a multiple of 4.51. Its historic multiple was about 2.75. So really, we're giving it a massive discount here just by using its current multiple. Its 5-year stock-based compensation adjusted free cash flow per share growth was 32.27%, believe it or not, at one point. Well, throughout the 5 years. Now, I've given it a huge growth rate slowdown of 66%, and that is because of the dramatic revenue slowdown. The revenue is now about 9 to 10% per year, whereas in the previous 5-year period, we were looking at, 20%, high teens, 20%. So also the free cash flow margin has peaked. So Mark Benioff has been working really hard to make Salesforce efficient, and now that it is really efficient, I struggle to see how he's going to get much more free cash flow out of the company. And also there's the AI replacement risk. I'm going to factor this in. I don't think this is a major risk at all. I think that they are the leader in AI agents and agentic AI, basically, which is basically AI that does replaces humans in jobs. And this gives me adjusted future flow growth rate of 10.97%, and shows me once I input these values, it gives me a 10.78% return from today's price. And the entry price for a 15% return is about $240. So I'm not actually going to be buying any Salesforce. In fact, at the minute, I'm kind of looking at selling out of Salesforce just because they are slower growing. I might swap all my Salesforce position for Meta, or put it into Meta and Amazon, both of them. We'll see. Maybe even MasterCard, to be fair, as well. And even a little bit Texas Roadhouse. I might just split it between things I have a bit more conviction that will give me a better return over time. Anyway, I only own 1,631 and my return is £201. On to Visa. Now, Visa is very similar to MasterCard. Its current multiple is 2.98%. Its historic multiple is 3.15. So I've used the historic multiple here. 5-year stock-based compensation adjusted free cash flow per share growth is 16.5%. Now, I've taken 5% off this value because MasterCard is actually growing faster in Europe, and I think it's growing faster in general. So this only means that Visa is probably losing a little bit of customer growth, and this gives me an adjusted future free cash flow growth rate of about 15.68%. So this gives a 14% return from today's price and an entry price of $343.96, so a little bit below what we currently are trading at for a 15% return. I think if you were to invest in Visa today, you would get some pretty good returns from it. I think it's a good idea. Obviously personally, I think the other stocks that are in my portfolio trading at a lower valuation are a better buy right now. But if you wanted Visa in your portfolio, I would definitely add it. Yeah. I own about 1,930 in Visa and my gain is about 500. So doing quite well with Visa as well. Moving on, my last one in the portfolio is FICO. I have a tiny amount of money in it, £22, and I did this at the bottom of the Trump tariff fears, and I wanted to see how low FICO would drop because it's a stock that I really, really like. I really want to get involved in, but it's just always traded at a really high valuation, and you can see that here because it trades at a current free cash flow yield of 1.34%. And like I mentioned before, the lower the free cash flow yield, the more expensive a stock is. The higher the free cash flow yield, the cheaper the stock is, depending on growth. Now, historically, it traded at a 2.5% free cash flow yield, so I've given it that because it's just trading at such a high valuation that I feel like that needs to be taken into account when we do this calculation. Now, its 5-year stock-based compensation adjusted free cash flow per share growth has been 23.47%, which is huge. And I don't think that that's going to slow down at all. They really have a complete monopoly over the FICO score. It's literally a requirement in order for you to get a loan. And also the amount that you pay for each loan is for each FICO score is so little in comparison to the loan that it's just no one's really questioning it. They basically have a toll booth on buying a house or taking any kind of loan. So in this case, I've selected 23.47% as the free cash flow growth rate, as you can see here. And I've doing the free cash flow yield 2.5%. And this gives me an 8.65% return from today's price. So personally, I am not going to be investing in FICO anymore. Not until the price drops a little bit more for me. Anyway, £22, 13% up. And yeah, that's going to be it for this video. No, it's not. Finally, guys, you want to know how big my portfolio will grow to if it grows at those very conservative growth rates for each stock I own. My estimated portfolio size by 2030 is $117,482. Now, obviously, I'm going to continue adding to my portfolio with my own money, so I do believe that my portfolio size in 5 years will be considerably larger than that, but I'm happy with those kind of returns. Right now, I've only invested about £34,000, so to get from £34,000 to about $117,482 is a big achievement in 5 years.